This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and thank you for joining us on this Easter Sunday for Money Talk, your weekly summary of financial stories. Both the Canadian and U.S. markets were oversold and have experienced strong rallies over the past 2 months of about 12.5%. And the Canadian dollar has rallied from its January 2016 low of 68.5 cents to about 75.5 cents basis the U.S. dollar, helped by a rally in the price of West Texas International crude oil from a low in early February 2016 of $26 U.S. a barrel to Thursday's closing price just under $40 U.S. a barrel. The U.S. Federal Reserve Board continues to send out confusing signals. In one breath, they talk about a strengthening U.S. economy and the need to raise interest rates, but then they equivocate when we get evidence that the global economy is slowing. It seems unlikely that the Bank of Canada will raise interest rates anytime soon. For me, the jury is still out on Bill Morneau's first budget that is intended to stimulate Canada's varied and tepid economy. I hope the money destined for infrastructure is spent on real, sustainable, job-producing projects like roads, bridges, clean water, etc. The Trudeau government has to prove that they can manage Canada not just with their liberal hearts, but with a conservative brain. It's too easy to rationalize tripling deficits these days just because most central banks in the world are playing a Keynesian stimulus game. Meanwhile, the U.S. presidential race is shaping up to be a fight between Donald Trump's growing constituency of very rich and angry, disenfranchised Main Street working and middle-class people against the rest of the country. And remember that it's always a good time to talk to your registered qualified investment advisor to ensure that you are being realistic about risk. Here's the show's lineup. We lead off with the Ottawa News with Tom Peckloff of the Ottawa Business Journal, then to Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management, and a brilliant interview with renowned investor Dennis Mitchell, who's Senior Vice President and Senior Portfolio Manager of the Sprott Focus Global Dividend Class. And after the news, we go to our affiliate BNN's Catherine Murray and her conversation with Kevin O'Leary, Chair of O'Leary Financial Group, regarding the federal budget. And on to our affiliate BNN's Francis Horodelski in conversation with BNN's Paul Bagnall. We conclude this week's show with the National Bank's chief economist and strategist Stéphane Marion in discussion with Paul Bagnall. But first to Tom Peckloff of the Ottawa Business Journal. Well, I'm joined by Tom Peckloff of the Ottawa Business Journal. Tom, thank you for joining us on Easter Sunday, and I hope the Easter Bunny has been good to your children.
Oh, my children and myself are all on the chocolate highs, John, chocolate highs.
Well, that's wonderful. Now, Tom, let's get down to the stories of the week around funding and expansion.
Yeah, that's right, John. We'll start with the 3dprinter.com. It's an Ottawa-based search engine for the 3D printing industry. Now, they announced this past week they secured almost $1 million from a European angel investor. They're getting about 25% of that right now, and they'll get more if and or when they hit certain benchmarks. Now, they're using the money to help integrate more service providers into their platform, which will help them get more customers, which will help them get more service providers. You see how that cycle goes. 3dprinter.com's Tomek Sizek said they turned to the European investor because, quite frankly, they just weren't having the best of luck finding the money here in Canada. And he said that the federal government wasn't terribly helpful either. According to him, if we go to the Canadian government, hopefully we would be able to find the right connections to get us in the right industries that might be able to benefit from 3D printing, but instead we ended up with people who didn't really understand anything about what we are doing or have the ability to get caught up on what we are doing. But now with this private sector boost, they're off and running again, and more investment news is expected soon.
And you have a couple of expansion stories. Which one is the first?
We'll start with Rhapsody Strategies. It's an Ottawa-based business coaching service. They have expanded stateside, added Jason Spears, who will lead and develop a coaching team in Atlanta, Georgia. Rhapsody General Manager Eric Deschamps says the firm is very deliberate in its growth strategy, choosing the team to make this happen. He says Mr. Spears' knowledge and extensive network in the area made him the right choice. The firm has worked with American clients before, but they now have an actual presence south of the border, and that intensifies their focus as their growth continues.
And just in time for Easter, Tiny Hoppers is expanding.
That's right, John. Tiny Hoppers is an East End daycare center. They're franchising out to Alberta. And if that isn't far enough, a center will open this spring in the Middle East. And there are opportunities developing in India as well. This is all coming as entrepreneurs around the world are recognizing the growing market for early childhood care. Now, Tiny Hopper's method of teaching, they teach math, language, science, and social studies through play, hands-on activities, music, and movement. And obviously, their methods are catching on. The corporate office in the East End of Ottawa provides extensive training for all the franchisees. That includes marketing training, business training, and all the teaching methods and the software they use as well.
And what's on the OBJ radar for this week, Tom?
Well, the Canada North BIA is hosting a networking breakfast this coming Wednesday, and the theme is on how we can build an autonomous vehicle tech market here in the capital. So that sounds very interesting. We'll be sending a reporter to that for sure.
Well, thank you for a good summary as usual. We'll talk again next Sunday, and enjoy the rest of the day.
I will. You too, John.
Take care. I'm joined by Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. How are you, Matt?
I'm pretty good, John. How are you?
You having a good Easter Sunday?
Yeah, not too bad. Way too much food, and I'm going to be paying for it tomorrow, but it's all good. It's all about family.
I'm excited because I've got a very good interview with Dennis Mitchell, who, of course, is the Senior Vice President and a Senior Portfolio Manager at Sprott Asset Management, running the focused global dividend class strategy. And he's talking, of course, about Warren Buffett, the famed investor, and it's a must-listen for people. Do you have any thoughts on this week, which has been really lackluster? We've had a tremendous rally in markets during the past month, which in my mind is a short covering rally, and it's certainly time to be careful, diversified, and all the things that we talk about every week.
Well, for sure, John. And then when we talk about the sleeve of Dennis Mitchell, I mean, he came over to us from his former shop. Dennis Mitchell's track record is impeccable. He was at his former shop for over 10 years. He ran 3 different mandates, and every mandate he ran, he grew the assets and outperformed his peers and his benchmark. And that's what he's doing already at Sprott. He runs a U.S. dividend strategy as well as a global dividend strategy. And he's outperforming his peers, and he's outperforming his benchmark. And Dennis is just a very, very good stock picker, macro guy. And so I really encourage listeners to take the time to listen to what he has to say. And if they have any questions, you know, they can easily get a hold of me. Toll free 1-866-299-9906, or always visit sprott.com.
Well, Matt, we're going to go to a break and then to the interview with Dennis Mitchell. Thanks so much for joining us today, and enjoy the rest of Easter Sunday.
Okay, John, you too, and happy Easter to our listeners.
Stay with us, folks. After the break, we come back with Dennis Mitchell on Buffettology. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Influential investors are voicing their views on how politics may affect the economy and the markets in this election year. Billionaire Warren Buffett says that the U.S. economy is in much better state than the candidates describe. So let's discuss this as well as other key takeaways from Buffett's annual letter with Dennis Mitchell, Senior Portfolio Manager at Sprott Asset Management. Dennis, good to be with you.
Good to see you.
Let's first talk about Warren Buffett's view of the economy and the market versus what all the politicians seem to be describing it as. He's saying don't ever bet against America.
Yeah, historically it's been a losing proposition to bet against the United States. I mean, between population growth, productivity gains, the U.S. economy has expanded. And so he did a little simplistic math, and he said basically, if you're looking at 2% real GDP growth compounded over 25 years, that means GDP per capita goes from 56,000 to about 76,000. So it's roughly a 20,000 GDP per capita gain over what is a generation. And then he looked at 1930 and the gains from 1930 to present. He says this every year in the letter to shareholders. The luckiest person on the planet is the baby born today in the United States. And it's because of factors like this. So the United States economy isn't growing at the speed that most people are accustomed to coming out of a deep recession. But we have to remember that there are a number of structural factors that are depressing that rate of growth. But he wants you to keep things in perspective. Things are getting better, just at a slower pace. And between productivity gains, innovation, and continued growth, the U.S. is probably one of the best places to live, certainly.
Dennis, one of the other things he says is that he does believe that the stock market will be higher 20 years from now versus today. And well,
I'll take that bet. Yeah,
I'll take that bet too. But the problem is, for many investors, between now and 20 years, particularly given where you may or may not be in your retirement years versus working and making income, et cetera. So how do you put that into perspective for, maybe it's for yourself, but also for all the people that you invest for, in terms of, we're going through this incredible volatile time. Can you withstand 20% declines in your asset base?
Well, if you can't, then you shouldn't be in the market. And I know a lot of people have said that, but it's absolutely true. So when I look at investing, I wish I could take a 20-year perspective or horizon. Unfortunately, innovation and productivity means people can evaluate me on a day-to-day basis. But really what I'm looking at is, are the businesses that I own going to be worth more going forward the next 1 year, 3 year, 5 years? And if that's the case, am I getting enough return to compensate for the risk I'm exposed to? And that's the way I look at it. And quite honestly, there are times where I may be wrong. There are times where companies may experience cyclical or unexpected downturns. If you're buying quality businesses that are going to be around for the next 5, 10, 20 years, as you've said, then those usually represent good buying opportunities, as opposed to times where you should panic. It seems like stocks and milk are the only things people won't buy on sale. Milk's probably a good thing to avoid on sale, but stocks are always a good bet on sale. All
right, let's talk about some of the company-specific stories that you own in your portfolio, as does Warren Buffett. Let's go through a couple of them. What do you like?
Well, so every letter and every MD&A, Management Discussion Analysis, he talks about the big four. So those would be American Express, Coca-Cola, Wells Fargo, and
IBM?
IBM, there you go. And should also keep in mind that he's got an option that expires in, I think, 3 or 4 years to buy 700 million shares of Bank of America, which would make it the 4th largest publicly traded stock that they own. So looking at those, we don't own Bank of America, we don't own Coca-Cola, we don't own American Express. We do own Wells Fargo, and I've owned IBM in the past, and I actually made money on IBM, but it's something that I haven't owned since I've been at Sprott.
Okay.
In terms of Wells Fargo, going into 2015 and into 2016, financials were one of the most overweight sectors for mutual fund managers, particularly U.S. financials, because the thought was the Fed is going to raise rates, that'll increase net interest margins. If that's in the context of a growing economy at 2.5–3%, then that should mean net interest income should grow as well. You might see some increased lending activity, might filter down into revolving loans, car loans, and so the thesis was that U.S. financials would lead the recovery. And so with growth kind of ratcheting down, Chicago PMI came out that was disappointing.
Very disappointing.
That thesis has kind of turned around, and so U.S. financials have actually underperformed, along with healthcare, for different reasons. So when I look at Wells Fargo, I look at, a bank that's historically underwritten risk exceptionally accurately, which means that their provision for credit losses and the reserves haven't sort of given the same volatility to earnings that other banks have experienced. They are one of the largest mortgage lenders. They're what I would call a utility bank, meaning that they've got a very core deposit-taking franchise and lending franchise, not a huge capital markets or even wealth or asset management franchise. So it's an easier bank to model.
But Dennis, when you take a look at Wells Fargo, and that has been one of the steadiest banks out there in terms of what you just described, the fundamentals, but also the stock price performance. But on their last conference call when they reported, they did disappoint the street. They were a little bit more cautious. What did you take away from the CEO's comments that has put this downward pressure on the stock, and has something changed?
I don't think anything has changed. And the thing to keep in mind is that oftentimes when companies miss analyst estimates, you have to actually think, doesn't that just mean that the estimates themselves were wrong? The company is what it is. It does what it does. And over long periods of time, they're remarkably accurate and consistent and resilient. So a lot of the times when you miss analyst estimates, it's simply because the analysts aren't as good at estimating how the business will do in the short term. None of us are, really. When I look at Wells Fargo and their reporting, generally the core franchise is fine. They're experiencing a moderate amount of loan growth demand. Net interest margin margins certainly aren't expanding, and that should be a reflection of what we're seeing in the economy as a whole. So I didn't take anything overly negative or pessimistic out of his comments. What I took it as, the pullback we've seen is yet another buying opportunity in Wells Fargo that you'll be able to compound on our numbers by 20% from, the current levels of around $46.
Okay. Dennis, when you take a look at Warren Buffett and owning shares in Berkshire directly, you have in the past. Do you still own the shares directly?
Yeah, we do. We own them in both of our funds, actually. So in all four of my funds, my Global Dividend, U.S. Balanced, and Global Balanced. Again, if you read the letter, he always says that they've compounded book value of about 20% since they took over. So that's why he's always willing to buy the shares anytime they trade at a discount to sort of that 120% of book value. So I think book value is around $112,000 a share. So if you're buying at sort of $135 or less, you can be sure that Warren's probably buying at the same time right alongside you at the same price. So, at current levels of around 136, I think, it represents, interesting or attractive. A month ago you could have bought it in the 120,000 range. That was better value.
How confident are you in their succession plans?
I put myself in Warren's, wouldn't we all like to put ourselves in Warren's shoes, and think, what would I do if I were in his position? And what I would do is I would create sort of leaders in each business segment to make sure that, once I exit stage left, really what you're left with is a series of capital allocators and a fleet or a board of people who then take over his responsibilities. So, you have Ajit Jain and Tony Nicely on the insurance side of things. You have Ted and Todd managing the public investments. You have Mark Rose on the industrial side of things. So I think what you'll see is the year, I don't even want to talk about it, but the year that Warren's no longer at the controls, you'll probably see at the annual general meeting 5 or 6 people on stage taking questions and reassuring you that capital allocation is well in hand.
One last question before we let you go. Again, in terms of his approach, and clearly it's been the winning approach, or in one of maybe a couple winning approaches. Let's be fair to other people as well.
Sure.
But I think that, when you take a look at some companies and have a very long-term view, I remember covering institutional money managers, and everybody could love stock XYZ as though it was going to go on for 30 years. It goes on for 10 years and then falls out of bed. How do you know that the ones that he's bought, like the Coca-Colas, American Expresses, these railways, are the ones that will always stand the test of time versus the ones that everybody else thinks will stand the test of time?
I don't think you can. The book that I read that changed my life was Buffettology, and at the back of Buffettology was a list of Buffett stocks, if you will, which included Fannie Mae and Freddie Mac and Circuit City. So they won't necessarily all stand the test of time. So that's one of the criticisms of Buffett lately. Is he wrong on IBM? Is Amex ever going to recover? What I would say is this. Warren owns a collection of businesses that he understands, and that's key. I think a lot of investors get enamored with an idea, but they can't necessarily tell you what the business does. So Warren owns a collection of businesses he understands that offer simple, repeatable, or recurrable services or goods to people on a large scale, and historically those businesses have generated strong returns on invested capital. He doesn't specifically talk about that metric, but if you look at the companies, they've generated strong returns on invested capital. And any business that generates a strong return on invested capital over long periods of time generally is well positioned to continue to do so going forward, barring revolutionary or evolutionary change in the industry, right?
Circuit City.
Yeah, or I'm thinking going forward something like
I'm glad you brought that up.
Cars, right?
Yeah, driverless cars. All right, Dennis, great to be with you. Thank you.
Thanks, Catherine.
Now to the news, and when we come back, Kevin O'Leary offers his thoughts on the federal budget, followed by BNN's Frances Horodelsky and her outlook for the markets. Stay with us. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Certainly a lot of people are still talking about the federal budget. There are fans and others who cry foul. Which camp is Kevin O'Leary in? He is chairman of O'Leary Financial Group, joining us now. Kevin, good to be with you. We had talked so much about this prior to the federal budget announced yesterday. Just under $30 billion. Are you happy? Deficit.
No, we've talked about how big the deficit could be. It's 3 times what was calculated, and everybody's talking about that. But I decided to talk to some bond traders, both in Europe and in the U.S. today, to get their perception. I like bond guys because they look at the longer-term systemic risk in terms of what the debt's going to be. And the Swiss bond person had a really interesting comment. He said to me, I haven't really looked at Canada in a while, but last time I looked at it, 36 months ago, you had a tax rate of about 46%, very competitive in North America, and balanced budget. I forget about it for 36 months. I look at it again. What happened to you? Your tax rates are as high as 54%. which makes you the least competitive in North America, and you're about to add $100 billion of debt, and there's no balance in sight. What happened? And that's, I guess, a good way to ask every Canadian, what happened? Look at the disaster Alberta's in. Look at the jobs losses. Look at the debt. And this budget is full of. I'm starting my work on it. I've got a couple of people going through it. There's some interesting ideas that could work. For example, the infrastructure for large cities on transportation. Assuming the private sector gets those contracts, the government doesn't try to do it.
Right.
That will be good because it'll enhance productivity. But then I find what I would call high risk. For example, the $7 billion on green tech. Well, we know with certainty 90% of that will go to zero, like it did in Ontario.
Right.
And then I see the really stupid stuff, like just sheer stupidity.
Like what?
Like indexing foreign purchases of Vancouver condos for millions of dollars. Who cares? How would that create a job? Who's going to use that data? That's just stupid government waste. And so I'm trying to decide the three baskets. Maybe it works. High risk waste, like the green, the $7 billion in green, and then stupid. And I think this budget gets us to 50% high risk and stupid. So
maybe it's not that bad.
Why would you say that?
You know, because it could have been worse.
How could it have been worse?
A higher deficit, more so than the $30 billion. What would that have done to the
bond markets around the world? But why are we spending in the first place?
But also the Canadian dollar.
What are we trying to solve for?
Canadian dollar. What are we trying to solve for? And I think that this is interesting, and it was brought up by the Manulife's economist who I just had on, Francis. And I think it's interesting. I think Canada is one of the first countries out there really to kind of go forward with fiscal stimulus, fiscal policy, not always just relying on our central bankers. And the fact that Canada, I think, managed through the financial crisis better than anybody else in the world, you have to wonder if this next move in terms of fiscal stimulus, although it's not huge, really, isn't the right move and the first move.
I don't see it that way. What I see here is fraught with risk because we're not actually in a recession. The government's only talking about 50 basis points of GDP growth, and they're going to spend $130 billion to get that? That sounds, well, stupid. Because when we do get a recession, what's going to happen? They'll have nothing left, and they've already maxed out personal taxes. You can't take more than half people's income. So the next thing you can do is start taxing corporations, and they all leave. So I think we put ourselves in a bad place when the real recession comes. I'll look at it this way. I'm old enough to remember when another Trudeau buried this country in debt for 4 decades. It took multiple administrations to get the budget back to a balanced basis. I think the new Trudeau is about to do the same thing. These guys are going to be gone in 4 years, and the new government's going to have to fix this mess.
And that is, of course, one of the key concerns. If you are going down the deficit path, and the world really does go into a recession, how much more do our deficits balloon versus expectations?
Well, that's why you talk to bond guys. This kind of puts bond people looking at Canadian debt saying one horrible outcome would be that we can't borrow anymore and that interest rates go up even while we're going into a recession. That was the Venezuela scenario. We're not there yet, but when you spend like this and you have no plan to get out of it, it's almost arrogant to say, yeah, who cares? We're just going to spend this money, and then we're kind of renting these guys for the next 4 years. Then the country's screwed.
Well,
where will Monod be if none of this works in 36 months? He'll just be the legacy guy that buried the country in debt. And Trudeau the same way. They'll both be gone.
But again, you talk about $100 billion 5 years out.
$130 billion.
Okay, 5 years out. Doesn't necessarily mean that money has to get spent at this juncture.
What do you think the probability is that a government doesn't spend money on stupid stuff? 100% probability it's going to get spent. We're going to have zip lines and all this garbage.
We're not.
Believe me,
Kevin, come on.
There's no evidence that government knows how to spend $7 billion on green tech and get any return or sustainable jobs.
Well, and people should realize,
show me the evidence.
No, I agree with you. I do agree with you on that. You know, having taken a lot of these solar companies public a decade ago.
They're all zero.
They're all zero.
So why are we doing it again?
I'm not
sure. What's the point? I mean, my point is, let's look at the budget that may help. But remember, we're only being promised 50 basis points of GDP growth. Here's how it's going to manifest itself. No new jobs, no wage inflation, and housing declines, and we're $100 billion more in debt. That's when they'll throw them out, and the new guys have to fix it.
How upset were you with the fact that energy really wasn't addressed?
So here's a really big issue. When you think about, that's probably the number one issue. The economy is based, the number one export's energy, and yet we threw them a $300 million tip and spent $7 billion on technology that we don't know is going to work. Shouldn't we have been better off spending money supporting industries that have produced jobs for the next 36 months and then let this private sector develop new batteries, new green, new wind, new solar, as opposed to the government? I don't know that Trudeau has a good track record picking tech companies in green tech. I don't see that in his resume. I don't see that in Morneau's resume. I don't know who this guy Butts is, but I don't see him running a hedge fund either.
Right.
So to me, it's just fraught with waste.
Joining us now with the Morning Buzz is, of course, Frances Wardowski.
Good morning, gentlemen. I tweeted out this morning that it feels like I only follow one person on Twitter because every tweet that I've read over the past 24 hours, 48 hours is calling for a market correction of some sort. So somehow I don't have the right people in my Twitter feed. And a lot of the reasons for this kind of expectation that we'll see a pullback, maybe it's happening today, they're listed here on this graphic. We've had a huge bounce off of the lows, and in many technical indicators, people are talking about we're overbought. The percentage of stocks moving above their 50-day moving average, we're through 90%. I think in some cases on the S&P 500, I think we're about 94%. So that's one of the overbought indicators. People are talking about the symmetry of the move in terms of days down, days up, days down, sort of about 26, 27 days. Complacency on the VIX, bullish sentiment is rising. It was a pretty good buy indicator at the low, maybe a sell indicator now. And this middle point about the buyback blackout period. So every quarter, first off, a lot of discussion that, the only buyer that has been consistent here recently has been the corporate buyer buying back their own stock. In fact, in the fourth quarter, buybacks were up in terms of volume, dollar amount, up 10% year over year. They kind of slowed in the fourth quarter versus the third, but still a pretty hefty amount of capital. But here's a graph. This is from Deutsche Bank looking at fund flows. It's very busy. I showed it earlier in the week, but I just wanted to show it again. The blue bars are blackout periods. So every quarter, corporate executives or corporate finance types at companies are precluded. They're waiting for their quarterly results. And the white line is equity flows. So there seems to be not a bad lineup as you move into the buyback period. Fund flows, pull back, and you can follow it with the orange line, which is the S&P 500. You tend to see a little bit of a sag. Now, is it causation or correlation? I mean, there's all sorts of things going on during quarterly earnings period, including, maybe we don't want to get ahead of those numbers until we actually see those numbers. Also, a lot of people talking about earnings recession. Are we going to get another bad quarter? And energy is going to be a factor there. So, correction, do you think we're setting up for one?
Well, it does seem that a pullback is quite possible here because you've had a great 6 weeks in the market. Mm-hmm. You've had a really volatile quarter, and I think the S&P will probably be about flat for the quarter. Canada is actually one of the best performing markets globally, so on the back of energy.
And gold.
And I'll be honest with you, Francis, I'm not smart enough to say that this is good time for a correction. It's going to be 5 or 10%. The reality is we've been long the U.S. market. We're gaining more confidence in the Canadian market. And why? Because of the fundamentals. When I look at what's going on in the U.S. market, I like where the consumer is going. Interest rates are going to stay low. So even though Bullard talked yesterday.
I know. Go figure all that. Where did he vote last week?
That's correct. And they seem to be changing their mind from week to week.
Stop
that seems to have caused this correction, especially in Europe. You'll probably see that follow up, at least in the first part of today's session. Markets are closed tomorrow. So I think that's causing some people to say, let's go on the sidelines. You're going into a long weekend. Kind of go to cash here for a little bit and see how this thing shakes out come next week. The reality is the fundamentals are strong, and Canada probably sees a better second half than it has in the first half. And I think that gives you a reason to say own equities right now in the market.
Where are the fundamentals strong, though? Economics economically, we may be better than less than 1% growth, whether it's Canada or in the U.S., but we're not 3% growth. So I still get a sense we're in that, average 2% economic growth with 2% inflation, nominal GDP, let's call it 4%, 4%. That's the top line. But we're not seeing that in a lot of companies. We're not even seeing that kind of top line growth.
You're right. I think the earnings picture tends to be a little murky right now, and you want to see where Q1 comes out, and we'll know that in the next 3 or 4 weeks. But from an economic standpoint, unfortunately, we're not at that 3 to 4% GDP growth that we've seen in other kind of bull markets. But we're still in that 2 to 2.5% range, which I think is where we're going to be with relatively low rates. And I think the U.S. consumer in particular, who represents about 70% of the U.S. market, is finally poised to start spending money again. Some of that windfall from lower energy prices, and even though they've bounced, oil prices are still pretty low. Mm-hmm. I think a lot of that money is going to start going into the economy and driving equities higher.
We'll see how it all unfolds with maybe a correction first.
Yes.
Thanks so much, Francis Swardowski.
Stay with us, folks. After the break, we conclude today's show with National Bank of Canada's chief economist and strategist, Stéphane Marion. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
There has been an historically high correlation between the price of crude oil and Canadian stock markets, but our next guest says that this firm correlation will back off in coming quarters. Joining us to explain why is Stéphane Marion. He's chief economist and strategist at National Bank of Canada, and he joins us from Montreal. Stéphane, it's good to see you again, and thank you for making time for us. I read your report on this a couple of days ago, and in fact we showed viewers what we call our chart of the day on that day, and it was based on your report showing a very tight correlation between the price of crude oil and the Toronto Stock Exchange as measured by the S&P TSX Composite. You said, I believe, at that time that the correlation now stands at 0.75. That's historically high, correct?
It is, and you know what's fascinating? Why would we be this high when the oil sector now accounts for less than 20% of the TSX? Last time we saw something coming near that level, the oil sector was about a third of the S&P TSX. So it's fascinating to see this type of correlation at this point in time, Paul. And the reason we're there is because the banks are trading on oil right now, which is quite unusual. So it's really the bank sector that's carrying the correlation higher, given the smaller weighting of the energy sector nowadays versus what it was in 2014.
So the energy stocks occupy less of the S&P TSX Composite than they once did, but the banks still occupy a very large piece, and it's the banks that are trading off oil. What is the connection between the bank valuations and crude oil? I mean, they bend over backwards, the banks do, to say that our lending to the energy sector is a small piece of our overall lending pie. Is this a case of market perceptions?
I think fears of contagion, and it's been overwhelming in recent months. And I can't blame investors. At some point, remember just a few months ago, we even had the Bank of Canada alluding to maybe negative interest rates in this country. So people were fearing the contagion, and I think it's still very much a trade that's in place. But Paul, I think that given the latest string of economic reports in Canada, maybe that correlation is about to become undone. So I still view upside for Canadian bank stocks in that type of environment, because I do believe that the economy is a lot more resilient, and the banking sector also, than just trading on oil.
Take us through the mechanics of this correlation unwinding, if it does.
Well, economic reports have actually turned positive last week for the first time in 3 to 4 months. So clearly, if it was contagion, that wouldn't be the case. We did get a stimulative budget yesterday from Ottawa. Probably gives us a fiscal stimulus of about 0.5 point of GDP, which is welcome news. And also south of the border, U.S. economic surprises, Paul, they've been negative since the end of 2014. That's why we've had this downward earnings revision in the U.S. and downward earnings revision in Canada too. But now we're about to turn positive in terms of economic surprise in the U.S. for the first time in over a year. So that bodes well for the export sector. So there are formidable offsets to just trading on oil for the Canadian stock market. So my view is that if I'm right, then obviously I would expect the correlations to break down between bank stocks and oil. And obviously, that still leaves some upside to the TSX, even if oil prices do stabilize.
What has happened historically when these correlation levels, either the correlation between crude oil and the TSX or bank stocks and the TSX, when they've reached historic highs? They are at historic highs now, both of them. You provided charts showing so in your recent report, but they've been very volatile over the period of time between 1998 and the present day. And in fact, there have been some occasions in which those correlations have been in negative territory, suggesting an increase in one is met with a decrease in the other. So what has happened historically when this correlation has reached an historic high?
It's a great question, right? And the correlations we're showing are short-term correlations. So it shows you what the market is trading on right now, what the current sentiment is. My view is that at some point in time, you have to reconnect with the longer-term fundamentals. And an historical correlation between bank stocks and oil should be around 0.35. So I do expect the correlations to become undone. Now, clearly, the question that you're asking is, where are we going in terms of direction? Again, my view is that I have oil prices stabilizing near current levels for the next few months, so limited upside on oil. However, if the rest of the economy shows resilience, which I expect it to show, then that gives you potential upside for the TSX. You readjust PE's valuation and function that the Canadian economy should do better in the coming quarters, so still some upside. That's why I'm still overweight the Canadian index, despite the fact that we've had a great run since the end of January.
And your view on the Canadian bank stocks, the sentiment has been neutral at best on those stocks for a while now, given what we've just been talking about, challenges in the Canadian economy and a weak price of oil.
I haven't seen contagion to the consumer sector that would justify a significant increase in loan loss provisions for the banks. So I still have an overweight recommendation on bank stocks in my asset mix recommendation.
What other sectors do you like among Canadian stocks right now?
Well, at some point, right now we're neutral energy, but clearly my view of the world right now is that we should start being a little bit more aggressive in terms of the cyclical industries, because I see U.S. dollars still on the weak side in the coming quarter, so that would benefit emerging economies and provide more impetus for the Canadian overall TSX. But clearly right now, an overweight on banks and neutral on energy. I have to see what's going to happen on oil price in the next few months. I do think that stabilization is a good possibility. What
about the mining sector? We've had companies like Teck Resources, a big base metals miner, rally significantly.
Yeah, I mean, Paul, this is all related to U.S. dollar call. Since I do see U.S. dollar weakness, you're absolutely right that generally speaking, the commodity sector should do better. Despite the fact that we've rebounded quite a lot recently, I think the valuations are still compelling if you think the global economy accelerates, which we believe it will in the next few quarters.
I'm interested in your view on the U.S. economy as well. Is the comeback there for real?
Well, I think so. I mean, as I said, we've had negative surprise in the U.S. since the end of 2014. This is an unusually long period of time without positive economic surprises, Paul, and that's why we've had downward earnings revision all along that period. So I think that what we're seeing again this morning, we saw it, the ISM numbers or the early ISM numbers suggest that the service economy should move up. You know, given the resilience in the labor markets, I think production should surprise on the upside, and I expect better news on the earnings front.
You mentioned early in our conversation the stimulative budget that we saw in Ottawa this week from the federal government. What's your view of the effect that may have on the Canadian economy? How much of an impact and over what period of time?
Well, they assume 0.5 percentage point on GDP, positive impact on GDP this year. That's welcome news. They assume also, Ottawa that is, that the fiscal stimulus will be the equivalent of 1% of GDP next year. These are significant numbers, Paul, if you consider that potential growth in Canada is around 1.4% currently. So we are one of the countries that is actually benefiting from significant fiscal stimulus for the next 2 years. So for that reason, I don't want to be overly pessimistic on bank stocks.
Okay, Stéphane, thank you very much for speaking with us today.
Thanks for having me.
That's Stéphane Marion. He's chief economist and strategist with National Bank of Canada. He joined us from Montreal.
Well, that's it for this week's Money Talk. Please join us next Sunday at 2 p.m. and enjoy the rest of Easter Sunday. I'm John Budden, wishing you good fortune